All right, so let's do this together. As mentioned, we have three sections. This section are the actuals, second section are the assumptions, third section are projections. First, we need to just carry forward the actual numbers so we can see it side by side, and that's pretty straightforward. We just kind of reference each one by one. Then we'll start our forecasting. The growth rate is given for sales, so we take the prior year sales times, open parens, 1 plus that growth rate, in this case 10%, close parens. So next year is 2,200. That sounds familiar. We used that for the SGR AFN just previously. Then we can copy that across, and we get our sales projections for the next 4 years. The next step is to get operating costs. So these are stated as a percent of sales. Sales are 2,200 times 90%. So we're going to copy that across. Next is depreciation. Here we have depreciation as a percent of fixed assets. So we need to get our fixed assets. So we go down here and we see fixed assets related to, guess what, sales. So we have 25% times sales. And we copy that across. Now we're able to do depreciation. So here we have 10% times fixed assets for the year. Copy that across. Next, we have EBIT. EBIT is simply the result of what we've done to date. EBIT equals sales minus operating costs minus depreciation. Copy that. Next, we have income tax. Income tax is given at 40% times the EBIT. If we know that, we then get to NOPAT. So NOPAT represents EBIT minus tax. Cash, guess what? Based on sales. How much of sales? 1%. 1% times sales. Accounts receivable also expressed as 14% times sales. Inventories also stated as a percent of sales, 20% of sales. Finally, we have accounts payable and accrued liabilities at 4% times, guess what, sales. So here is our forecasted financial statements using data that we had for 2016, creating assumptions related to sales or derived from another account that's related to sales, in the case of depreciation. And then we have these key numbers. Now these seem like random numbers, but they're not random. It's exactly what we need to compute free cash flow, income statement, and balance sheet. So it's like a dozen or so line items, and it's all we need to do some pretty interesting things. So what we see from our forecasted numbers is that a few things. First, this assumption section gives us some flexibility. We could alter these elements of costs that would change our operating margin or our NOPAT margin. The second thing we see is that the percentages, such as fixed asset to sales, we set at 25%, but it could change over time. And the last thing we see is that this particular model is pretty simple, right? It's arguably even a little bit simplistic, that we can be able to generate 5 years forecast, I guess 4 years forecast on such a handful of assumptions that all tie back to sales, either directly or indirectly. So it's both simple and simplistic.